be retiring and not standing for re-election. So Teresa Floyd and Dave Opie both announced their retirements. Neither one of them will be running for the healthcare board next year. So we're going to have vacancies for a manager position in the Eastern District and a manager position in the Central District. So if your manager at your co-op is interested in serving on this board, we'll be looking for names of people who are willing to serve. We will actually do the election at the 2026 annual meeting, which is not until August. So we've got plenty of time to decide, but we'll kind of just keep talking about that as we go forward, because we'll need to fill those positions.
So you're calling about the check that was under two different families or whatever.
And we're still getting a lot of voices. We can ask everybody that, other than Allison and Chris, make sure you're muted. Wow. Okay, so I want to talk about the flex spending and health savings accounts for 2026 and introduce some new players. So Apprise is the name of our a company that we partner with to do our enrollment. We put in an automated enrollment system called bSwift a number of years ago, and our primary goal in putting bSwift in was to automate the handoff of enrollment information to Wellmark and to Delta Dental and to Avisus Vision. And so that's been going on for a number of years, and nothing really is changing there. But we're going to move some of the other things, administration things, onto that bSwift platform. So we'll be moving Cobra, which really doesn't impact the co-ops directly, since we take care of all the Cobra stuff. But we're moving the Cobra administration onto that platform. We're moving our Section 125 administration and our health savings accounts administration onto that platform. And those, you'll hear the term Elevate, and that's the platform that Apprise works with. So Apprise is our partner. Elevate is the administration platform that will be on for that Section 125 and health savings account administration. So we'll be entering those enrollments into the bSwift system, and that's how we'll be getting that data onto those new platforms. And that's going to change some of our processing as well. So there's a number of benefits we think we're going to experience to consolidating all of that enrollment information onto bSwift, and I think it'll make things, it'll be easier to resolve issues when they arise. It'll allow us to give you more access to your employees' enrollment data if you're interested in having that access. And then it'll allow us to eventually get all the Hawkeye insurance enrollment information onto that platform, and starting for not for the 2025 reporting year, but starting for the 2026 reporting year, Apprise will be able to do all of the Affordable Care Act reporting for us, so that your 1095 reporting that has to be done every year. So for this year, for 2025, that will be the same. We'll be sending you the file that we get from Wellmark. But then for the 2026 year, which will happen in the early part of 2027, Apprise will be taking care of that reporting for us. So we're excited about getting everything consolidated onto one system, because we think it's going to do a lot of good things for us. So particularly on the flex spending administration, and I'm going to flip it over here to Allison, who's with Apprise, in a minute, to walk you through a couple things and take questions that you might have. But so the flex spending, that's the Section 125. We've got 13 co-ops right now that are doing the Section 125 plan through our facility that we have. So all of that's moving to Elevate for 2026. The biggest change that you're going to experience there is they're going to base everything on what they call spend activity versus your payroll schedule. So, uh, and Allison will go into this too, but you'll get debited um, by by a prize when you have claims on your flex spending accounts, versus the way we've been doing it with our current vendor is every time you had a payroll, we were collecting those contributions from you. Um, so now it's going to be money's going to get collected from you when you have claim activity on those flex spending accounts. But much of the rest of it will be the same. Obviously, people get new cards and things like that. So that's going to be the biggest change that you're going to see on that flex spending account administration. On the health savings account, a couple things to keep in mind there. We've been with, or many of you have been with Optum Bank with us for a number of years. And if you want to keep working with Optum on your own, you're certainly free to do that. I know some of you are working with local banks or other banks on your own, and that's great. You can continue to do that. But we will have the Elevate platform available, and it'll be a fairly easy, I'm told, transaction for your employees to move their health savings account out of Optum and into Elevate if they want to do that. And even if you want to move over officially, if you've got some employees that just like the Optum thing and want to stay with it, they can do that because it is their account. The big thing that's changing though is um, we're getting out of the handling of health savings account contributions. When we first set this up quite a number of years ago, we started doing it as a convenience to a couple of the co-ops, that it was all brand new to them. But as the participation in our high deductible health plans has increased dramatically over the course of the last 10 years, it's become a kind of a huge thing. Plus, our attorneys tell us we shouldn't be doing it anyway. Um, Most of you, if not all of you, when you're having your employees um, make contributions to their health savings account, you're actually doing it through your 125 plan and taking pre-tax contributions. And our lawyers say that we really, as a third party, shouldn't be handling that. So we're going to move away from that. And again, we'll be working with Allison and with you guys here over the course of the rest of this fall to get that transition moving forward and going smoothly for you, both on employee contributions and for those of you that make co-op contributions to people's HSAs. We'll help get that all set up, and so you guys will be working directly um, with a prize, or if you stay with Optum, you'll be working directly with Optum on that. So that's the plan, and with that, um, I'm going to turn it over to Allison Doomer, who's our um, chief know-it-all from Apprise, and just to kind of walk through a couple of slides that she sent over. So when you want me to change, Allison, just let me know, but go ahead, take it away.
Sure, thank you so much. Hello, everyone. My name is Allison Dummer, and I work with Apprise, and I've been with Apprise for a number of years, and I've been in this pre-tax FSA, HSA, COBRA business for a long time. So we're super excited to be working with all the individual co-ops. We would love to have you see the benefit of coming over to Apprise and move all of your people to Apprise wherever possible. And certainly that's always up to you guys and to your individual needs. As Tim said, Apprise are the people that you will be working with, and Elevate is the engine or the platform that you'll be working with. So you'll see both of those names, and sometimes they're used interchangeably. We work very closely together, and you'll get a lot of emails directly from the Elevate platform, but you'll also get emails from Apprise as well. And when you're reaching out to a person, you're reaching out to me or my team. And when you're logging into a system, the system is the Elevate platform. So A couple of things regarding some changes that Tim had mentioned in funding. Accounts in the Elevate platform are based on spend activity except for HSAs. So we're talking your medical FSA and your daycare FSA. So what we have asked is for each co-op to fill out a bank authorization form. And that's basically a form that allows Elevate to debit your bank account. It's an ACH authorization form. And you, as the co-op, are 100% in control of your funds at all times. So instead of processing your payroll and sending your funds off to Optum and hoping that Optum keeps track of those funds and knows what they have and pays the claims correctly, etc., you are responsible and you have full control of your funds at all times. So you will process your payroll, hold all of those employee contributions for the FSA plan, and then as your employees either use their debit card and spend some money for a copay or a prescription or something along those lines, Apprise will then only debit your account for that amount. Claims are processed daily. Manual claims are submitted daily. Debit cards are submitted daily. But remember, everyone in your co-op isn't going to have a claim on the same day. So we're not going to hit your bank account every single day. We're only going to debit your bank account when claims are paid. There is also an email that you tell us who needs to get that email. Who at your co-op is the person that is responsible for that bank account? And that person or people will get an email on a day that a claim was paid saying, hey, we processed claims in the amount of $50 and we are going to now debit your bank account $50. So all of that information is conveyed to you before your bank account is debited, etc. There is a pre-fund or an impressed deposit that is required, and that is up to 1% of the annual contributions or $500, whichever is less. And that is automatically debited from your bank account before the 2026 plan year starts. So right around the last week of December. And that money does sit at Elevate and is used to pay claims and used to facilitate the process. So for the most part, I think some of your co-ops are fairly small and some are fairly large. So it might be the $500, it might be $1,000. That money does sit at Elevate and you get that money back when the plan terminates. But the rest of the time, like I said, we're debiting your account only as claims are happening. Any quick questions on the account funding before we move on? Okay, let's go to the next slide, Tim. Like we talked about the pre-fund calculation, it's calculated on the total election amount. And then there are some other options. So our standard is daily processing with a 1% imprest. However, if you would prefer to only have your bank account debited once a week or once a month, there are some other options. So the funding is adjustable based on your specific co-op needs. And in the authorization form that you will get from Tim and Chris, there is an option for you to pick the 1% daily, the 4% weekly, or the 10% monthly. So just know that that is an option. That only counts for FSA plans. The HSA is still contribution based. So as you're processing your payroll, you will be telling us at Apprise what you're withholding from your employees' payrolls for HSA contributions. We will post those contributions to the employee's account, and then we will debit your bank account for the full HSA contribution for that payroll. So just a quick note there. There are always some exceptions. We can talk about those things. Certainly, if you have concerns or any of that, bring that to Tim and Chris, bring that to us here at Elevate. We would love to talk through those specific things with you. But in general, this is going to keep you more in control of your funds and knowing where your funds are at all times. All right. Like I said, there are invoices and reconciliation reports. So invoices are generated, and an invoice is us telling you what we're going to debit your bank account. ACH debit transactions are after 2 p.m. Eastern on the day the invoice is generally generated. So you'll get the email, but the next day is when you'll see that hit your bank account. Anytime we've got a refund or a return to the debit card, that's going to be included in our calculation. So there may be, you may get an invoice that says there was $100 worth of claim spend, but we're only pulling $50 from your account. And that might be because there was an adjustment to someone's account. So we're only pulling from your account the funds that we need to cover claims for that day as a whole. And then, like I said, there's reports available. There are all kinds of information available. Each co-op can have whoever they want have access to the system to be able to look at the reporting and the funding, and you'll only be able to see the information for your co-op. So we want to make sure that you understand that you're going to get information from Elevate on a semi-daily basis, and there will be bank account transactions happening, but all of that information is available to you 24/7 on the platform. This is the form that we were talking about. So this is the form that you'll get from Tim and Chris. We're just looking for you to fill out, your legal name, your federal EIN, who the contact person should be that gets those reports. Choose your funding. Is it going to be daily at 1%? Is it going to be weekly at 4%? And then we want your bank information. And then you'll sign that form and you'll return it, and we'll set that all up in our system. And then you'll want to let your financial information or your financial institution know that Elevate is an authorized user. And we've included here anything from Elevate that's pulling out of your account is going to be listed as UMB Bank, and there is an ACH identifier. So you can let your bank know that this is an authorized transaction.
I'm going to jump in here for just a second,
Yes,
Allison.
thank you.
I have 10 co-ops that I currently work with and do the transfers with Optum. And those are the 10 that I'm going to send this out to later today. If you don't get one from me and you feel like you should have, I'll have them out to you by noon. Please be sure to reach out. Thank you.
Thanks, Chris.
Also, if you're one of the co-ops that's in our 125 plan, even if you don't have you don't have HSAs at your co-op, we'll be getting this out to you as well. Because it's the same form, whether it's HSA or FSA.
Yep,
Thanks,
correct.
Tim.
Yep, it is the same form. Yep.
Okay.
All right, do we have another slide?
Well,
Oh,
I did
fantastic.
receive some employee directed information on this, so I'm just to put a couple slides on there, and we'll get that out to everybody after the meeting this morning. Do you want to talk about the debit cards a little bit?
Yeah.
Because that is different in terms of how the enterprise platform works.
Yep. So with the debit card, there's a couple different things. So number one, as we process enrollments toward the middle of December, once open enrollment is done and we process the enrollments and get everybody's FSA plans up and running, and then also the HSA plans, if your co-op decides to move your HSA elections over to Apprise and Elevate, a debit card will be ordered and mailed to that employee's home. We only start with one debit card. That doesn't mean that you can't get more. Your employees can have as many debit cards as they want, and there's no cost for debit cards. All they have to do is log into their online Elevate portal or contact us here at Apprise, or even contact Tim or Chris, and we can get more debit cards ordered. So no worries there. That debit card is one card for all accounts. So if you've got, there aren't multiple cards like you might have with Optum or some of the other providers. If you have an FSA, you use your Apprise Elevate debit card to pay for your FSA expenses. If you have a daycare plan, you use that card to pay for your daycare expenses. If you have an HSA, you use that card to pay for your HSA expenses. So it's one card that accesses all plans. And the card is what we call a smart card. And it knows, based on the information it gets from the terminal that you swipe your card in, it knows which account to pull those funds from. Those cards are going to come in extremely plain white envelopes. Please let your employees know. Anyone that is moving their FSAs or their HSAs over to Apprise, they need to watch their mail for this debit card. Just like any other banking card, it's going to come in an extremely white, plain white envelope. Be on the lookout for it. Don't think that it's junk and throw it away. But that's how you're going to pay for your expenses. You can also add that card to your digital wallet. So Apple Pay, Samsung Pay, any of those kinds of things. You can have this card in your digital wallet so that when you're at the pharmacy, you can just, pay with your digital wallet. Or if you're buying things on Amazon, or if you're buying things at the FSA store, eligible items can be used or can be paid for with your debit card through a digital wallet as well. We want to make sure you keep your receipts. Just like any other FSA plan, just like with Optum, just like with any of the other providers, Apprise may ask once in a while for a receipt, and that is to make sure that the plan stays compliant with IRS regulations. Okay? It's not because we care what you're doing. You are responsible for your FSA, but we want to make sure that the entire plan stays compliant, and that is our job to do that. A number of questions or a number of just some FAQs about the card. One thing we like to say is you don't need a PIN. You never need a PIN for a transaction. You want to use your card as a debit card, or excuse me, as a credit card, but you won't need a PIN to use your card at all. So just a quick note there. Also, once enrollments are complete, each employee will get an email welcoming them to the Elevate platform with a link where they can go to create their online account. So that welcome email is going to go to the individual employee along with the debit card being mailed to the individual employee's home. So that's going to be the employee's responsibility to create their username, create their password, download the mobile app, do all of those kinds of things to be able to manage their FSA account individually. Anything you think I missed, Tim?
Have any questions popped up, Chris?
No, but I encourage any of you to please do it now while Allison's on board with us.
Yeah.
Yeah.
And um, I have one other thing here. I'm
Yep.
not sure if you want to go through this, but
Sure.
before we go to HSA, while we're still on FSA, Allison, can you talk a little bit about how the transition from iSolved will work in terms of their 2025 FSAs
Yes.
versus 2026 and the timing
Yes.
on some of that?
Yes, thank you. So iSolved will continue to process claims and continue to pay out claims for 2025. So you will continue to send those things to iSolve, anything 2025 related. Apprise will be responsible for anything 1/1/26 ongoing. So I think, whatever the runout is, you'll want to make sure that you're spending that 2025 money. If there is a rollover. So if your plan, your particular co-op plan has a rollover, once iSolved is done processing everything at the end of the runout, so sometime in early 2026, once everything is done processing, we will get a balance report from them and we will load those rollover balances to the employees' accounts. So if the plan that you participate in has rollover, that will still happen. You don't have to spend your money down to zero. We will still do the rollover up to the IRS maximum. That will just happen a little bit later in 2026, not right away at the beginning of the plan year. If there's the carryover, so if your co-op participates in an FSA plan that has the carryover, you will continue to send expenses to iSolved and continue to use that debit card until that account is spent down or until the end of the carryover, or excuse me, the grace period, grace period. So, and then you will have your 2026 account available at a price to use anytime you've spent the rest of your 2025 dollars. But if you have the grace period attached to your plan, meaning you have extra time to spend your 2025 dollars, you will continue to send those to iSolved until your 2025 balance is zero.
So the key is not the date of the expense necessarily, but which FSA do I want to apply it to?
Correct.
If I still have money in my 2025, and if I submit an expense that's 2026 into my new Apprise 125 plan, then I won't be able to use that money from my last year's iSolved 2025 plan. They can only
Yep.
put it, I can only put it in once.
You can only, use it once from which, and so it's important for your employees to decide which plan they want to use the funds from, to make sure that they're using all of the funds.
Right.
If
And
your
they can access that currently, but we will, when we get late into December, we'll pull some reports off the iSolve system and make them available to the co-op so they can see who's got balances left.
Perfect.
Okay.
Charlotte had a question on what is the process if the daycare doesn't accept debit cards. You can either pay the same way that you've been paying all along, and then you'll just log into either the online or excuse me, the mobile app or the online portal, and you can request to reimburse yourself for those funds that you're paying out for daycare. The other thing that you can do on the mobile app and the online portal is you could actually pay your daycare directly. So funds from your payroll get deposited into your daycare account. You could actually log in and request that a check be sent directly to your daycare from your Elevate Daycare FSA. So if the daycare does not accept credit cards or debit cards, there is still a way for you not to have to pay out of your pocket. So just a note there. And certainly, anytime you guys have questions, concerns, you need help walking through, your employees need help walking through, that's what Apprise is here for. And we have a phone number that goes to our call center, and then we also have an email address that we monitor all throughout every business day. And we are constantly answering questions and helping employees with these sorts of things. So if anyone needs any help, they can call or email Apprise and we will help them.
I do have a couple other questions that came in.
Yes.
If an employee chooses not to participate in FSA for 2026, but has funds to roll over from 2025, will everything be rolled over to Apprise?
And I believe that the general answer to that is yes. Certainly, any account that has rollover, we will go from iSolved to Apprise. I believe, Chris and Tim, correct me if I'm wrong, but I believe we have an auto enroll set up. So we just need to know what that rollover is, and we will be able to create a 2026 account for that employee.
Okay. So it'll it rolls when we get to the end of the time period, which
the
is
run
actually
out.
kind of close to the middle of the year because I think there's an extra period tacked on to submit claims. So so then it would actually create a 2026 account for them if they don't already have one, and that balance would get on there so they won't lose the money.
No, they will not use the money. And what will happen financially at the co-op level is as the accounts are closed at iSolve and everything is finalized, those funds that iSolved has been holding on your behalf will come back to you. and you will hang on to those funds as they're rolled over into 2026, and Apprise will again only debit your account for those funds as claims are spent. So you as the co-op will be getting all of your funds back. You will hang on to them, and then Apprise will use them as necessary.
Okay.
The next question's about HSA, which we'll get into.
Okay.
And then the last question, Tim, could you just repeat what you said about the 1095s?
Okay, 1095 reporting for the calendar year 2025, which we'll all do in the first part of 2026. That'll work the way that it's been working, where we get that file from Wellmark and we send you the spreadsheet that's got all of the month by month enrollment information on it. So for 2025 reporting that we do in 2026, it'll be like it's on you to do it, basically. It's on each of us to do it. But for the 2026 year, which will happen in the first part of 2027, that's the first time that Apprise will be doing that ACA reporting for us.
Another one popped in.
Section G.
Can you explain the funding a little bit more? We currently contribute both employee and co-op every pay period. Would the co-op pay the claims while the contributions are still being made throughout the year?
Yes, it is possible that the co-op would have to front some money for an employee that had a large FSA expense at the beginning of the year. Now with HSAs, remember HSA contributions, which are either the employee only or the employee and the co-op, HSA contributions are only available to be spent as they're added to the accounts, as they're pulled from the co-op bank account and added to the employee HSA account. However, with the medical FSA, it's the same thing for daycare, but with the medical FSA, one of the pros or cons, depending on your viewpoint of the medical FSA, is the entire fund is available to the employee at the first of the year. So the co-op may end up then fronting some funds to the FSA for that employee, but you're getting those funds back through every payroll. So you're hanging on to that liability or that debit. Yes. And if that didn't answer your question, Charlotte, let me know.
Those were the last ones to pop in.
Yeah, let's talk HSA. So with the HSA, again, the money is there as the contributions are happening. So as the contribution and the payroll files are being processed, Elevate is pulling from the co-op bank account and depositing to the employee HSA account. There are also, just like any HSA, a ton of investment options. And we also have a self-directed investment, or we have a managed investment option, where the employees can actually log into the online portal, answer some questions, and get some help with how to invest their funds. So they can do it completely themselves, or they can have some managed investment help through the Elevate platform. The HSA is on the card, available at all times, and any other HSA, whether it's the current HSA you guys have with Optum, or whether it's an HSA from, 20 years ago or 10 years ago from some previous job, those funds can all be consolidated into the Apprise and Elevate HSA. There is an easy form that can be filled out, and we will help the employee fill out that form. It gets sent to Optum or to the previous HSA administrator. The account gets liquidated, and then those funds are transferred over to Elevate. So the transfer process is very quick and very easy. The other option would be continue to use your Optum account until it's spent down. Maybe you only have a few $100s in there. Leave it there, spend it down, continue to use your Optum card. You can have both HSAs at the same time. So you can spend down your Optum HSA as your contributions are going into your Apprise Elevate HSA. Then once your Optum HSA is down to zero, you then just start using your Elevate card, and that gives you access to the new HSA funds. So there's the great thing about an HSA is it's an employee-owned bank account, and they have full control over when they spend it, how they invest it. It goes with them when they leave the co-op, etc. It's no different than any other HSA plan. You pay for healthcare expenses with your HSA. The HSA, of course, is a little bit more lenient as far as what is considered a medical expense, so just know that. And again, online access, super easy through the online portal or the mobile app. Either way, and you can reimburse yourself, or again, you can pay a provider directly from your HSA account. There's always that option as well. Any questions on HSA or anything else we should talk about? There was one question
Yeah, let me pull
about the
that up.
fees, and I'll let Chris and Tim discuss the fees.
The question was, well, we had mentioned that people could keep their current Optum balances and not roll it over. However, they would be paying the monthly fee instead of the plan. That is a $3 fee. And if Tim, you want to talk a little bit more if a co-op or an individual stays with Optum?
Well, yeah, I think you just said it. The right now, um, the the plan is picking up those account management fees, both at Optum, um, and I'm not sure what. So if somebody wants to keep that Optum account going, they will start in January. They will start getting charged that monthly fee. I think it's $3 a month. That will start getting charged out of their HSA with Optum.
Does that answer the question?
Hey, Chris,
Yeah.
are we able to transfer the money from Optum to Apprise before January so that they're not getting charged for January? Or what is when will people be charged for the $3 out of their account if they have a balance in January? Can you kind of help us figure out how that will look?
The HSA at Apprise will be open as within a day or two. Remember, there's an ID process due to the Patriot Act to open that HSA bank account. So there is a process there that does take a day or two. But once we have the enrollment at Apprise and once the HSA account is open, certainly the employee could move their funds there anytime at the end of December that they wanted to avoid that $3 fee. Yes, as soon as the account is open, a transfer can take place. As far as when Optum bills for January, I am not sure about that. That would be a question for Optum.
When will you start billing? Let's say they put money in their account in December. Are you going to start billing in January?
Yes. Yep. And
Okay.
those fees, that's between you guys on who pays those fees. I don't believe those fees are charged to the employee.
And who do we notify, or how do we notify how much each employee will be putting in their HSA?
Yep. So that's a really easy spreadsheet that I did that can be shared with you guys. Or it's just an email to Apprise, and that email comes in to the Apprise email box. It tells us each pay period, which we need you to tell us which employee and how much was an employee contribution, how much was an employer contribution, and then we post those to their accounts. If you, as a savvy financial person, want to post those yourself, we can show you how to do that in the system, but we're not going to require that you learn how to do that. And literally takes 2 minutes if you do decide to do it yourself.
So
And
this,
I'm assuming you probably have a tutorial of
Oh, yes.
of
Yep.
what that would look like,
Yeah.
so we can
Yep.
decide, look at it and
Yep.
decide.
Yep.
Okay,
Super
thanks.
easy. Yep.
and thanks for being patient with me. I have a question.
Yes.
What is the date that my co-ops need to get the information to me so that we know to get the account open for for employees? You know what I'm saying? When do I need to have that information into Be Swift so that you guys can start opening accounts?
Oh, gotcha. So for I mean, any time is fine, but
Okay.
we would like to have your enrollments earlier in December if at all possible. Because remember, the one thing that kind of sometimes holds up people having access to their account is the debit card. And we can
Right.
only guarantee debit cards in hand by January 1st if we have all of your enrollments before December 5th. So just a note there.
Okay.
That's the
So
only date we can guarantee.
I'm gonna say by noon on the 26th then.
There you go. So noon on the 26th is everyone's deadline. Thank you.
Ta-da!
Our co-op would like
Okay.
to deposit HSA funds directly into the accounts through our direct deposit payroll process. Yes, we can certainly help you do that, Kent, as well, and we can provide those bank account and routing numbers. As soon as all the accounts are open toward the end of December, we can provide you that information directly from the system, and then you would be able to direct deposit into those bank accounts.
Okay. We do have another FSA question. The co-op is responsible in 2026 to track employee contributions and payments. Is this correct? Such as
Yes.
preparing an Excel spreadsheet for each participating employee,
Oh,
their annual election, and then to track payments out during the year.
no,
Or is there a report generated by the plan on a monthly basis?
yeah, there's absolutely no reason that you should have to have a spreadsheet for each of your employees and send that out to them each and every month. That's a lot of work. They will get from the Elevate system an email on a monthly basis, which is basically a balance report. And that email says your FSA currently has a balance of blah, which would be their annual election less any claims paid. Your HSA currently has a balance of blah, which would be, the contributions to date less any claims paid. I mean, certainly at a co-op level, if you guys are concerned about finances and you want to generate those spreadsheets for your employees throughout the beginning of 2026 so that your employees are very clear on what's happening and some of those kinds of things, that's up to you. But I would say don't bother doing that much work. The employees themselves, as part of the process, will receive monthly balance reports from the system.
Thank you.
Yep.
Do we have any other questions? These have been great, so I appreciate the input. I'm not seeing any.
Okay.
Great. Well, thank you, Allison.
Yes.
This has been helpful. And obviously, any questions that pop to mind, let us know right away, and we'll get answers. We'll be moving pretty quickly now that we're through getting all of the enrollment information collected. We'll be moving pretty quickly on getting all of this set up in time, so everybody's got their cards, and hopefully, we'll have a nice, smooth transition. All right. Well, I think we're gonna move forward then. Allison, thank you again.
Yes, thank you. I'm going to go ahead and drop off the call so that I don't hear any of your fancy secret financial information. But
Okay.
as Tim and Chris both said, we're here to help. We're here to partner with you. Any questions, any concerns, certainly reach out to Tim and Chris. They will reach out to us and we will get you through this transition. So thank you all very much and have a fantastic Friday.
Thank you. Well, we're going to run over our hour here, but I think I'll cover the healthcare stuff fairly quickly because it was really kind of a quiet quarter altogether. But so just to give you a update here on our year-to-date experience. This is through the end of September. We're continuing to run a fairly sizable surplus in the healthcare plan this year. So our claims that have come in versus our contributions year to date were a little over $2 million ahead. So that's good, because any time that we're ahead, that money just goes into our reserves. It stays with us. That's the advantage of being self-insured, is that if we collect more money than we need in one year, that just stays in the plan, and we have that available to use as opposed to paying premiums to an insurance company. So, so we were almost even there in that third quarter. You can see the 22,455 surplus, but for the year we're at 2 million. Now we do have more seasonality in our plan because of the high deductible. The number of people that have high deductible plans, they hit their deductibles later in the year. So we'll see what happens in the fourth quarter. But so far we're halfway into the fourth quarter, and we haven't seen anything blow up on us yet. So it's looking like we're going to be able to replenish our reserves for this year. So that's always a good thing to be able to do. Large claims are still an issue for us. Six claims that kind of hit the threshold for being considered large claims. And as you recall, we did limit our exposure on this at the beginning of this year. So that turned out to be a good move for us. We pay higher premiums on our reinsurance, but it limits our liability to the $250,000. So that's turned out to actually have been fortunate timing for us to make that change at the beginning of this year. Just looking at trend quickly, the 2025 charts are on the left and the 2024 charts are on the right. So you can see we've leveled out that trend in 2025 because we've been having this really good experience. So we're trending now at 2.8 annual rate versus 8.3 a year ago. And this tends to flip from time to time, but we're looking here over a 3-year period on these, and so that's always good. It's good to have these trend lines be as flat as possible. So, and same thing on the prescription drug side. We're actually trending negative on prescription drugs a year ago, and we're trending pretty flat on the prescription drugs so far through this year, again, looking over the 3-year period. So that all looks really good, which is what you'd expect given the year we're having. In terms of our returns on our reserve funds, you can see the 1, 3, and 5-year returns on our reserves have been pretty positive, and compared to the CPI medical, which is an approximation of the medical inflation rate. We're keeping up with that number. I'm not sure that's a perfect measure, but there isn't a better one really out there. So that's what we look against. So our reserves, this is as of the end of September. Our reserves are just a little over 9 million. So that's about almost 5 months. It's about 4 and 3/4 months worth of expenses. Our target on our reserves is 3 to 6 months. So if we're sitting on between 4.5 and 5 months, we're just right in the middle of our target range. So we're glad to see that we're where we want to be on that, and not low, or it's not horrible being high, but if you're high for year after year after year, that's something you want to correct. But so we're right where we want to be in terms of our level of reserves. Some other things then on the other plan issues. So last date for 2025 enrollment changes is November 26th. So that would even be if you've got changes that take effect for December. we just can't put those into Wellmark after the 26th. So that's our cutoff on then. So if you've got new hires in November that are going to be enrolling as of the 1st of December, please let us know as early as you can in this month. And then again, we talked about HSA contributions. We're stepping out of the middle of those beginning in January, but the last date we can get those and get them in is going to be the 29th of December. Just a couple of other things as a reminder. Our telemedicine services are now 100% paid by the plan for all of our plans. That's a change from what we've had before in terms of in the high deductible plan, being able to cover those at 100%. We can do that now and going forward, so we are. So for the telemedicine services that's available through HealthJoy, there will be no consultation fee charged to the employee or to the family member, regardless of which plan they're on. The HealthJoy joint Joint relief, the MSK plan, and the chronic care plans are available to everybody now plan-wide. We had to restrict those just to Plan C in the past, or Plan C and Plan D in the past, but now we can offer those through Plan E as well, because they're under the one big beautiful bill. They're considered telemedicine services because of the way they're delivered, and so those are able to be provided to employees, even though they haven't met their deductible in the high deductible plan. So we call that first dollar coverage. I throw that phrase out without even thinking about it sometimes, but when you're talking about high deductible plans, generally speaking, everything goes towards the deductible with only a couple of exceptions, preventive services and now telemedicine services. So if I throw out that term first dollar coverage, that's what we're talking about. It does not have to be charged to the employee. And so we set up our plans to, if it doesn't have to be charged to the employee, we don't want it to be charged to the employee. So that's the way we've set up our plans. And that's all in effect. That was actually, change was made retroactive to January 1, and we've already amended the plan for 2025. So all of those things now are open to all employees in all plans, and including the EAP. We've talked about that. That's just a reminder that those services are also included with our HealthJoy application that we have, and that's up to 3 sessions, short-term counseling and referral services is what that is. I just want a reminder to everybody who has the vision plan, because Avisus got purchased by a larger company. They changed some of their criteria. We had to make a change this year from our self-insured vision plan and go on one of their standard plans. So there's a couple of differences that are going to hit our plan starting in 2026. Most of it is the same. The network's all the same. We decided to stay with Avisus so we wouldn't have all the network disruption. The material copays are a little higher with this new plan than they were under the old plan. The contact lens, the contact lens allowance is higher on this plan than the old, so those kind of offset. And then there's the 12-month versus once a year exam issue. So on our self-insured plan, we could just say once a year and we didn't have to care. Now that's going to be 12 months and they're going to track it. So if I went in August of this year for my vision and I try to go in July of next year, that's not going to be 12 months. So it's an inconvenience kind of thing, but we don't really have any control over it. The rest of it is basically the same. So people will be able to use the same providers and they'll have those same benefits that we've been having before. And we'll get that information out as well. So I just want to remind everybody, I think we talked about that at the last meeting, but we didn't have all the details on it because we were still looking around to see, but it just made sense to us to stay with the Avisus because the economics of it were actually pretty good. And we didn't want to have all that network disruption. So that's where we are. I'm going to flip over now and talk about the pension plan. So are there any questions related to the healthcare plans before we change our subjects here?
I don't see any.
Okay. All right. Well, we'll get all of these documents and things out onto into your share file folders, so we can get going on that with the FSA, the HSA stuff. So those of you who aren't interested in the Hawkeye pension plan are, well, any of you are free to go at any time anyway, but you might want to go now. So thanks for joining us. And I'm going to switch gears now and talk about the pension valuation. So we had our presentation at the Hawkeye board meeting on the 4th of November, and you got the summary information via email in terms of the 2026 contribution level. So I just want to walk through a little bit and we can kind of see where we are. So some of this is just changing, data changing. So we're a little higher in terms of our total number of participants than we were a year ago. We're a little bit younger age, which tends to be a positive in terms of plan cost, to the extent that age and number of years in the plan are correlated. And you can see our active service there, average service for active employees did decrease a little bit. So that helps the plan economics when people haven't been in the plan as long. To look at our assets compared to 2024. So market value of assets is really kind of just literally money in the bank. So plan assets increased from 108.5 up to 121 million, and we're actually, that was as of July. Right now we're at about 130 million in plan assets. So those are good returns, both on the market value of the assets and on the actuarial value of the assets. Remember, the actuarial value, we do this smoothing. So when we have excess returns or excess losses, we book those over 5 years instead of all in 1 year, and that's the difference between actuarial and a market value of assets. And so just it was a year of good returns all around. That's what I take away from this slide. So our official funding status, in other words, what's going to cause us to have to put more money into the plan? This is that CSEC, Community Small Employer and Cooperative Pension Plan rules that we operate under. And so you can see our status on this from 24 to 25, and we increased on our funding level from 93 up to 97. So that's obviously good. We talk about different ways that our liability gets calculated. This one happens to be the most favorable. So this is the best funded percentage number you're going to see when you're looking at this restoration status. And the key here is if that number, our 97.6, if that falls below 80%, then we have to take immediate action, which means we have to put more money into the plan right away than we're putting in. So 80% is the threshold on that. Anytime that number is above 80, whatever our current funding methodology is, we can continue to use it. They're not going to step in and force us to increase our funding, although we would want to do that anyway. But so that all looks very good as well. Then looking at our present value of our accrued benefits from this year to last year, and this is really the cost in today's dollars of all of the benefits that have accrued so far. So you can see that's gone up, and then when we compare that to the actuarial value of our assets, we can see our funding levels there. And again, we use different methods for different reporting purposes. and I'm not going to go into a lot of details on that other than to say you can our funded status did improve significantly from 2024 to 2025. So and then if we look at our valuation results in terms of normal cost, and this is the kind of what the IRS looks at. And so in this case, we would have been, under the IRS method, they come up with what our minimum required contribution is. And because you can apply this credit balance that we don't talk about anymore, our actual minimum required contribution from the IRS this year is 0, but nobody thinks putting 0 into the plan would make any kind of sense. And so that's the IRS required contribution there. So we're not really going to look at that because we're intending to, well, we're going to use our funding policy, and we're really not going to focus on the IRS requirement anymore, but we still have to generate those numbers. All right, so so when we look at our funding policy then, which is the policy that we've implemented in the last year, we start with what our actuary tells us that they think we should have. And that's this actuarial determined contribution. And what we've said as a matter of policy is if our funding status falls anywhere between 95 and 105%, we're going to consider ourselves to be fully funded, which just means we don't really have to take any extra action. We're where we want to be in terms of funding. So we'd like to consider stability in setting the contribution rate. So we try to avoid large changes from one year to the next. If economic conditions would cause us to have to increase our funding rate from one year to the next, there we will be much more likely to make large changes than if the conditions say we don't we could potentially decrease the funding. So if we can decrease, we're going to decrease slow, we're going to increase fast. That's the bottom line on what our policy says. And then we have to look at what the IRS says, but that's really not anything that factors into it because what we're collecting on our policy is so much more than the IRS required amount. And so we used to talk about this credit balance and receivables, and those still come into play because we have to report everything. But really what we want to look at for our own funding policy is we want to look at our actuarial value of our assets. And so that's what's the smooth value of what we have in the bank, which is that right-hand column. So when we talk about what's our asset level, we're looking at that 121 million. And remember, again, that's as of July. We're actually above that now. So using that, what would be an kind of the target that you'd want to look at would be a 17% funding. That's that total normal cost accrual rate. But that was looking at our assumed rate of return for the plan at 7.5%. Many of you will remember that our assumed rate of return for many, many years was 8% in the plan, and it dropped down to 7.5%. And this is something that's determined by the actuary. So it's the actuary's call on what it should be. And so our actuary looked at that this year, looked at our current assumption and looked at other models that they look at, and our actuary determined that we should make an adjustment for that. So our assumed rate of return is going to go from 7.5% down to 7.25%. It's still a little high for pension plans, And so there could be some more downward adjustment on that in the future. But it's something that they don't necessarily look at every year. But frankly, given the market returns of the last 2 years, whenever you have high returns in the market for a couple of years, then their going forward numbers are going to look lower because you've had a couple of super years. So that's kind of what's going on here. So these forecast numbers looking forward are looking lower than they've been in the past. So bottom line is it's the actuaries' call for purposes of our plan, and the actuaries made the call this year to drop that from 7.5 to 7.25. So that has an immediate impact on our funding situation. And you can see the difference here between 7.5 and 7.25. So our funding status at 7.5 was actually a little over 91% as of July 1. But when you adjust for that assumed rate of return down to 7.25, that drops our funded status down to 88.6. That's the number that we look at for our policy. There's lots of other numbers that get created for other reasons, but for our funding policy, this is the number that we look at as the actuarial value of our assets. And so it would have been 91. It's now 88. I can't remember last year what it was, but it was lower than that last year. So even with the adjustment in the assumed rate of return, our funded status has gone up. So this is the number we're trying to get up into the 95 to 105 range. So that we're at 88 right now, 88.6 now. And then so when we adjust again, adjust all of our normal cost numbers down from the 7.5% assumed rate of return to the 7.25%. That causes our liabilities to increase. That causes our accrual rate to increase slightly. So where we would have been, could potentially have been at 17, we're now 18.3. So this is the number that the actuary is looking at and saying, this is the number we should be working toward for on a long-term funding basis. It's that 18.37%. So if we're putting in 18.37% or more, our actuary is not losing sleep over our funding. So that's the number we worked at, and that number will change over. It changes year to year. So you're always chasing a moving target, so to speak. But that's the number we want to be working toward. And as you know, this year we're significantly higher than that number. So our long range target for funding 18.37. Our funded percentage in 25 is at 88.62. So we're not where we want to be. And so we want to be funding at a higher level than that target until we get to that 95 to 105 range to where we want to be. So the funding rate current year was 23.75, and the Hawkeye board on the 4th of November set the 2026 rate at 22. So we're working down towards that 18, but we don't want to go down too fast. And so they settled on 22 as being, not a huge jump downward, but moving towards that long-term number, and that's what we'll continue to do going forward. And so that's how we came up with that number. You can see that number is still higher than what it quote needs to be, but our funded percentage is lower than we want it to be. So that's what led to that decision. It's a lot of numbers, but I think that's I just have some disclaimers in here and some definitions, but that really is that's the gist of it. We're working down towards the 18% range, and we want to get that funded percentage up into the 95 to 105 range. So that's what I have to talk about on the pension. Are there questions about that?
I don't see any.
Okay. Well, thanks for sticking with us for as long as you have this morning. We'll get all of
Oh,
this
we
information
do
out.
have one question.
Okay.
It popped away. Hold on. Hawkeye annual meeting is June 2nd. And do you have the health plan annual meeting date set? We
We
do.
Here, let me see. I got it in my
It
notebook.
is
August
August
18th.
the afternoon, and it's virtual also, so I will get that out on your calendars. All right, I think that was it.
Okay, and just Hawkeye does use a nominating committee to nominate people for board positions. So that nominating committee for next year has been named, and we'll be working with them to come up with names. If there's somebody at your co-op that's interested in being on the Hawkeye board, let us know. And we'll certainly, if somebody's got an interest, we'll certainly pass that information along to the nominating committee or can answer any questions about it. So, but that's where how the nominating process works on Hawkeye is generally through the nominating committee, where on the healthcare side, we have to beg. Oh, that's probably overstating it, but we have to put out put out the feelers on there because there's no formal process for not getting people nominated on the healthcare side. Okay. Any other questions?
No?
All right. Well, we're going to let you go then. Thanks for joining us. And anything that comes to mind, please let us know. We'll be getting a lot of information out to you here in the next couple of days, and we'll be moving forward pretty quickly on the FSA, HSA stuff now that most of you have gotten all of your enrollment information back to us. So thank you for doing that. And thank you for participating in this. And we're going to let you go.